Hello, good morning guys. Today, our discussion is part 4 of Module 3 on how to prepare partnership. So this is income tax for 2021. Let's start. When you say partnership, it means a business having 2 to 15 co-businessmen to open up a business with the intention of having profit or maximize its capital at the end of the year. Partnership will be handled by general partners, and some partners can be a limited partner, silent partner, etc. Distribution of profits can be divided through ratio and proportion, based on percentage, based on its beginning capital, or based on its ending capital, etc. Board of directors can be a member or not part of the partnership. So board meeting is needed to discuss, implement, evaluate, and approve matters on handling the partnership business. So there are different tax considerations for partnership. So you need to know first what kind of partnership it is. So taxation of general partnership is not the same with taxing a professional partnership. So here's the trivia. Taxing general partnership is just like corporate income tax begetting its 30% income tax. But after dividing the net income among partners, they need to pay 10% final tax to the BIR as part of their personal share. Okay? So when taxing professional partnership, it is just like professional tax. So partners are entitled to get first their share of net income before deciding if they are going to use the 8% outright tax or using the withholding tax table. So if ever they opt to use 8% outright tax, then they have to use withholding tax table once their sales falls on 3 million up. So taxing for withholding tax formula, so it's the same. So sample 1 is ABC Partnership had an annual sales of 900,000 with expenses of 268,000. So this partnership is a general partnership having a 30, 50, and 20% sharing of profit. Compute the statement of operation of ABC Partnership. So here's the computation. We have the income statement or the statement of operation. There is a sale of 900,000 minus the expenses. So we have 268,000. So the remaining is the operating income, which is the basis of the 30% tax because the problem is a general partnership. So you need to compute the 30% income tax of it. So we have 632,000 multiplied by 30% in order to get the tax of 189,600. So if you deduct these two, then the net income is 442,400. So this net income will now be the basis on sharing the annual profit of ABC partnership. So this is the sharing or the distribution of net income to partners. For partner A, the remaining amount, which is 442,400, will be divided for partner A for 30%. So 442,400 multiplied by 30%, so they have 132,720 minus the final tax of 10%. So 10% of 132,720 is 13,272. So the share of partner A less all the taxes is 119,448. Or it is the take-home income of partner A for this year, 2021. For partner B, we have the 442,400 multiplied by 50%. So if you multiply these two, then it is 221,200 minus the final tax of 10%, which is 22,120. So upon deducting these two, we have 199,080, which is the share of partner B. For partner C, we have 442,400 multiplied by 20% because the sharing of profit is 30, 50, 20. So partner C had 20%. So 442,400 times 20% is 88,480. So deduct the 10% final tax. So basis is 88,480 times 10%. So we have 88,480. So share now of partner C upon deducting these two is 79,632. This is the take-home income of partner C. So sample number 2 is ABC Partnership, so same problem, had an annual sale of 900 with expenses of 268,000. So this partnership is a professional partnership. So this time, we are going to compute professional partnership. Having a 30, 50, and 20 sharing of profit. Compute the statement of operation using an outright tax. So here it goes. First thing that we are going to do is to get the statement of operation. So we have the sales of 900,000 minus the expenses of 268,000. Then we have the operating income of 632,000. Because this is outright tax, what we are going to do is to distribute the 632,000 among partners. So here's the computation. So we have 632,000 for partner A times 30%. So we have 189,600. But because this is outright tax, then the computation of 8% outright tax is based on 900,000 or based on the actual sales multiplied by 30% times 8%. So the tax of partner A is 21,600. So deducting the share and the outright tax of 8%, the share of partner A or the take-home income of partner A is 168,000. For partner B, so our basis again is the operating income of 632 multiplied by 50%, so it's 316,000. But when you compute the 8% outright tax, you need to get the actual sales of 900,000 multiplied by 50% share multiplied by 8%. So you have now your share or outright tax of 36,000. So deducting these two is 316 minus 36. Share of partner B now is 280,000. For partner C, we have the operating income of 632 multiplied by 20%. So we have 126,400 minus the outright tax basis is 900,000 times 20% times 8%. So we have 14,400. So the take-home income of share of partner C is 126,400 minus 14,400. So we have 112,000 for partner C. You can view now our sample number 3. So our sample number 3 is the same with the problem of sample 1 and sample 2. But this time, the computation will be based using withholding tax table. Okay? So again, this is the statement of operation, which is sales minus expenses is equals to operating income. So 632,000 will be now the basis for the computation. So we have partner A is 632,000 times 30%. So the share of partner A is 189,600 pesos. So if we are going to take a look on the tax, okay, so the minimum bracket is 250,000 up. So because it is only 189,600, so it is zero rated tax. So she is not entitled to any tax. So under train law, earnings below 250,000 is not subject to tax. Okay. For partner B, if you are going to compute 632,000 times 50%, so there is a computation of 316,000. So this income will now be put on your gross compensation income as a basis for your tax. So 316,000. So if there is any other income, so you add it. But in this problem, we have no other income, so it's 0. So total income is the same with the gross compensation income of 316,000. So deduct the government contribution. So we have the SSS, which is the maximum is 1125. So we have maximum of 1125. So 1125 times 12. So we have 13,500 for the SSS. For the PhilHealth, we have 100 times 12. So we have 12. So 13,500 plus 12. And then for the PhilHealth, we have 316,000 multiplied by 3.5% divided by 2. So we have 5,530. So if you add all the computation, the government contribution is 20,230. Okay? So allowable deduction can be computed up to maximum of 90,000. But because there is no other income, so there's nothing to compute for the allowable deduction. So after getting the total income minus all the deduction, the government contribution and allowable deduction, we now have the taxable income of 295,770. So the annual tax is 250,000 is 0. So the remaining amount is 45,770 multiplied by 20%, we have 9,154. So the annual tax is 9,154. In order to get the monthly tax, we need to divide it by 12. So 9,154 divided by 12, so we have 762.83 monthly tax. Okay, for partner C, if you are going to compute 632,000 multiplied by 20%, so the take-home income is only 126,400. So since the income received by partner is only 126,400, and the distribution of income is subject to withholding tax policy, then she is not entitled to pay any tax because under train law, earnings below 250,000 is not subject to tax. So this is the end of Module 3 on partnership, Part 4. So I'm just hoping that you understand all the lesson tackled on our taxation. Bye-bye!